Good afternoon. A very warm welcome to the Chartered Bankers event on operational resilience. My name's Stuart Birnie and I'm a director at PwC who leads our technology risk and operational resilience team in Scotland. While today's session is a webinar, we want to make it as interactive as possible, so please send through your questions using the functionality on the webinar and we will try our best to answer them. The agenda that we're going to cover off today will cover three main areas. I'll do a little bit of an introduction to talk about operational resilience, what it is and where we've been to, where we've came from on the journey of operational resilience. We'll then do a little bit of a regulatory update and then we'll talk through some of the big issues we are seeing as we are working with firms. I'm not alone today. I'm joined by two of my colleagues, Peter Jack and Lewis McKenzie, and I'll ask them just to do a brief introduction.
Hello everyone, I'm Peter Jack. I lead our Trust and Transparency Solutions proposition here in Scotland. My background is very much helping our clients understand and manage operational and technology risks, often across businesses and with third parties. We'll come on to hear a bit today, but third parties is very much a challenge which we see a lot of in the operational resilience space.
Hi, I'm Lewis McKenzie. I'm one of the senior managers within our financial services, IT risk and operational resilience Centre of Excellence in London. I spent the last 3.5 years with the firm helping the full spectrum of financial services clients understand operational resilience and plan their end-to-end management of that risk.
Excellent, thank you very much, guys. So, in terms of moving on, so start at the start with what is operational resilience? So operational resilience can be defined as an organisation's ability to protect and sustain its core business functions when experiencing operational stress or disruption. As the text in the slide outlines, it's an outcome and not a function. It's going beyond traditional DR, disaster recovery or business continuity, and views services, critical business services, from a customer point of view in order to protect the processes that are most critical, as I say, and allow a firm to respond in a coordinated manner should an incident occur. Operational resilience, I said, was an outcome, not a function, and that's because it will involve everyone across the business. But very much in our experience, if it is to be successful, it must be business-led. So, when we're talking to, so in terms of the journey we have been on in terms of getting here, this very much started to get focus in 2011, 2012 through the RBS event. Since that time, there's been a number of Dear Chairman type letters, there's been spot checks by the various regulators, and a few incidents that have happened as well. And that ultimately led to the joint paper being issued by the Bank of England, PRA and FCA on July last year. There's been a number of developments that have happened since then, and I don't want to steal Lewis's thunder because he will cover off in a few of those in a minute or two. When we are looking at operational resilience, we think about 7 main steps that organisations have to go through when they're doing that. Firstly, there's establishing the mandate for resilience. So that's getting board level buy-in to an understanding of what resilience is. The second part is identifying what matters most. So that's understanding what your critical business services are. Then understanding the risks associated with those business services, be that risks related to third parties that provide them, or technology, or people, or premises, and then setting our tolerances in terms of what's within risk appetite or what do we need to further mitigate. Then what you have is building and sustaining your integrated operating model for operational resilience, through to point 5, which is your governance and control environment, so getting that board involvement in operational resilience, having the MI flowing up to them so that they are able to take an active part in challenging and supporting with it. And then moving through that stages 1 to 5, which is developing your capability into what you might describe as BAU for stages 6 and 7. So that ongoing assessing resilience of business services end to end, and then where you're identifying those gaps on a continuous basis and remediating them. Now, the next thing I'm going to try and do is use the technology, because it would be very interesting to understand from you where you see your organisation. So, I've opened the poll now. So based on those 7 stages, which stage do you think your organisation is at? In terms of stage 1 and 2, stage 3 is B, stage C is stage 4, stage 5, or stage 6 and 7. So we'll give that I've got a countdown in front of me that says 30 seconds, so please give us your votes so we can see what is coming through.
I think as we kind of wait for people to consider the steps and where they may be as an organisation, I think we use this methodology whenever we review across the sector as to whether we're looking at implementing a resilience programme or we're starting to do an internal or external audit. We typically see most financial services organisations in steps 1 to 3. It really is a bit of a challenge, kind of getting the board comfortable in setting that risk appetite and making sure they understand what they need to be doing, what they need to be looking at. While the poll tells me slightly different here, I think some people out there are bold enough to think they're in stages 6 and 7. We typically only find some of the big retail banks in that kind of BAU delivery of really kind of turning the handle on resilience and making improvements because they were forced into it through the Dear Chairman 1 and 2 exercises. Interesting results there, kind of a 50-50 split between stage 3, so kind of understanding the risks and setting tolerances, and the stage 6 and 7 BAU delivery. Moving kind of forward, Stuart, thanks. I wanted to give a bit of an update in terms of the regulatory agenda. There's been a lot of activity on resilience in the last, since 2012. There's been a slow creep of activity from the regulators. They were really both PRA and FCA to understand what's happening across the sector. Things really started to warm up or hot up, which is probably a strange term for resilience, at the start of last summer, when the FPC released a paper in June. Hidden away in one of the boxes further down the document was a reference to impact tolerance and stress testing, and the aspiration from the FPC that resilience risk will be measured and stress tested alongside financial stress testing by 2020 and be on equal footing. And then nothing more came out on that until 2 days ago. The PRA, the FCA and the Bank of England jointly released a discussion paper on operational resilience. Lyndon Nelson and the team there felt it was important for them to give some direction as to where the financial services should be in terms of resilience and the kind of activities you should be undertaking. The kind of key change in that was towards business services, away from the critical economic functions. It was found by the regulators during some of the reviews that non-retail banks who didn't align to any of the CEFs that were released in 2012 hadn't done any of this end-to-end mapping and weren't looking at resilience in the right way. So they've changed that. People will go through a bit more of that later on. And then what does that mean to the sector? Just click on the slide there. It's interesting. It's really kind of codified the regulatory expectation for resilience. The new regime should be in place by the end of this year, although we have, while scoping a number of 166 reviews for the FCA and a 195 for the PRA, we have been asked to consider the new requirements of the discussion paper as part of those reviews. So although it's not it's not in yet. They've started to move the goalposts without anyone watching in the background. More recently, there've been a couple of things just kind of worth touching on. A number of challenger banks and building societies have received a request from the supervisors to conduct an internal audit into board MI and reporting, which is causing some people a bit of a headache now. I think it's accepted that boards are not seeing the right level of detail, and they're kind of struggling to actually manage evidence the management of resilience through that kind of reporting that's coming up to them. The FCA released the report on cyber and technology failures, which is an interesting read, some good kind of tips on what to do and what not to do, and the Treasury Select Committee have released their focus area on operational incidents.
Lewis, you picked up there around we're expecting the regulation to come through sometime later this year.
I think that the original intention, and guarded in my words, it would be definitely out within the kind of towards the end of the first half of this year. A number of things have got in the way, notably Brexit, and it's going to take a bit more focus from the regulators. But we believe from the kind of discussions we've had with them recently that they've taken the feedback from the discussion paper now. Their consultation paper is in draft, and that will be out within half two of the year, and policy will the policy will follow soon behind, so it should be by the end of the year. Is the long answer to the short question.
And I guess a follow-up question to that, and one that I can see coming through here as well is, so if we're expecting that to come to policy maybe end of the year or early next year, when's the right time for people to act? Is it hold on and wait to see what the actual policies say, or is it crack on right now? We get a feel for it.
I think that. A good question actually. Some people have said they're not going to do anything because they spent a lot of money on conduct risk before the regulators said what actually conduct what they wanted, so they're kind of sitting and waiting. I would suggest that if you're not in a place now where you've fully mapped your critical business services and you have a real understanding of all the interdependencies, if you don't have that now, you're not going to be able to catch up with the regulations. So that's certainly the activity for right now if you're not on it.
And that's a nice segue in terms of, the regulation is not going away. There's more and more stuff being published around about this and chat around about operational resilience. So firms should be dealing with this now. And we are seeing a number of firms that are doing that. But in doing so, we've called out 4 issues that we continually see firms based on our work with them, but also interactions we are having with the regulators. We'll talk about each of these in more detail, but in summary, the first one is setting up the resilience programme. Secondly, understanding and mapping out end-to-end business services. Thirdly, the concept of impact tolerances and how to apply them. And finally, stress testing and what this means in terms of the level and nature of testing that should be performed. Now, as I say, we're going to pick up these in more detail in a second, but I'm going to try and use the technology once again and do a poll. I'm interested to understand whether these resonate with those on the call. So, we've got a poll up on your screens just now, which is, which of these 4 challenges is the biggest one you're seeing? So is it setting up the resilience programme? Is it understanding and mapping out end-to-end business services? Is it impact tolerances or stress testing? So 4 options there. Or is it something completely different? And what I'd ask is, if it is something completely different, send it through using the functionality so that we can pick that up through the remainder of the conversation. And while you're all still voting, please keep sending through questions so that we can make sure that we address them. So I'll give it another few seconds to see what is coming through in the voting here. So we seem to have 2 out in front, which is setting up the resilience programs and impact tolerances and mapping out end-to-end business services as well. So pretty much equally weighted, with impact tolerances a little bit out in front. We're going to keep that open for the final few to get their votes in, but it's probably worth moving on and actually starting to talk about these. So, Lewis.
So I think one of the first questions I'm often asked is, what does good look like? You know, is there what if you're in doing a review or 166 for the regulators, or you're kind of in building a program, what's the end state? Where should we be, and what gets us to good? I think there and the artifacts of support that are deliverables. I think that ultimately governance is key. I think that your organisation needs to be able to demonstrate that you have the resilience from the top down, set at a board agenda, and they're having MI reported to them on a quarterly, at the minimum basis, and they're really kind of driving decisions and strategy supported by resilience. And then kind of diving into kind of some of the more operational parts of this, it's to have a program that is set up where you've defined your business service criticality. You understand what is important to you as an organisation financially and to your customers. You've tiered those, so you're doing everything for the most important areas, and you're kind of doing some slightly less resilience activities for the less critical activities you've got. All of that's been kind of agreed and signed off and approved under the governance level, so you can evidence when the PRA or the supervisors are asking what's happened. You've conducted that end-to-end mapping, which people talk about in a bit more detail later on. You've validated that process, and you've taken the existing BIAs you've got within the organisation, your impact analysis, your existing risk control assessments, any technology recovery plans, the risk register, and all the kind of artefacts you've already got available to you, and bring those together to really analyse what's happening on that end-to-end process, so you can understand the gaps, and you have a plan in place. It's a 1 to 3 year plan of improvements and investments, whether it's in your technology or the program enhancements that you want to take yourself forward.
Just a quick question on that. So we talk about resilience programs, and we were kind of, I guess where we've been in the past has been very much seen as BCP or disaster recovery being owned by technology. Where do we see kind of ownership for this land, or is that kind of evolving?
I think that there are a number of answers to the question. I think the SMF 24, the senior manager regime, is pretty clear that's where it exists, and where the accountability will ultimately be led from. Where I see resilience programs kind of fall flat on their face is when you've rebranded your IT disaster recovery and your BCM into something that's just the same. You have the same conversations, and typically you've left it within the CTO, CIO line, and the business don't believe it's something they should buy into. It's just a technology activity. Where I see it run very well is when the COO and the kind of frontline business own the resilience program in the first line, and because they own the risk of the process not working. It's their customers, it's their bottom line that is affected, and they can then really drive technology and hold them to account.
So I imagine a fair shift to make that happen from technology into first line.
It is, and it's proven to be a slightly uncomfortable shift, because you need people within first line COO world to be able to understand technology and really challenge the technology provision that's there, and the third parties to. It's a kind of change in mindset and slightly different skill set that's required to move it forward. The final part of what is good is having that program of testing and improvement, so you're reporting on it constantly, and you're evolving the program, and you can evidence that your strategy has brought resilience together. You're making improvements. You're doing the right thing for yourselves, and importantly for your customers, and you can evidence that journey to go forward. A good quote from one of the leaders in resilience in the financial services at the moment. We asked her how she knew resilience was successful across her bank, and said because it was in the culture. We talk about it, it's part of every change, it's part of every incident, it's part of every strategy meeting you talk about the resilience implications, and it's truly embedded, and that's when you kind of know you've got where you should be. Now, I kind of touched on business services there. I think it would be good maybe to give a bit more detail on what is the business service and maybe kind of bring that to life a little bit more.
Yep, will do. So I'll pick up then on business services and also prioritisation of business services, which is something which the regulator is kind of viewing that firms need to start doing. This has really been a bit of an evolution from what we've seen in the past under old PR or BCP regimes, where the view's taken very much from a system or process view, so quite a linear, quite a siloed approach. The expectation now, as we kind of touched on previously, is that there's very much now a look at services, so something which is far more dynamic and is going to cut across different systems, going to cut across different processes, and is also going to cut across potentially third parties as well. So a fair bit of change in the mindset from the regulator and really pushing through that change through firms. In terms of kind of bringing that to life a bit then, so what the regulator is actually expecting is that you take all the services that your firm provides. They don't expect you to prioritise resilience across all of them. They expect you to prioritise what are your absolute critical business services, and what we've got on the slide is some filters which are suggested that might help you do that. So we've got, for example, a financial filter. You might apply regulatory filters, geographical filters, dropping out some of those services which you don't think are key to your customers. And what you'll be left with is a smaller set of what are absolutely the critical services that you and your firm provide to your customers. To give that, I guess, give that a bit of a feel, so some of our kind of bigger clients, we've seen under the old regime of maybe hundreds of BIAs covering individual processes or individual systems. We're seeing that drop down to maybe 10 to 15 critical business services, so the number that we're looking at is coming away quite a lot. Unfortunately, it's not all good news that you are expected to do a lot more with those critical business services, and the understanding that you build up for them goes far beyond what's expected in the past. And I think we've picked up a few times now where the regulator is trying to get to this, is that you really understand the full end-to-end of that service as it cuts across different services and as it goes out to your third party. And the next slide really just kind of builds on that theme. So this is an example of a component of what an end-to-end map might look like. What we've got here is a level 3 flow chart, which a number of you may have kind of seen across different processes. But a few key points just to pick out here, and that's this relates to a specific business service, a critical business service. But you can see there it captures the individual teams that are involved, the locations that are involved, the different bits of technology. And also extends out into your third parties. So we are expecting quite a lot here and quite a lot of engagement with your third parties, which is going to be new. And what we've found when we've spoken to our clients that have started this process is it's not really straightforward for them to pull this together. It's taken a lot of time, taken a lot of effort. You can imagine it's not one person who holds all this knowledge. It's different teams, different people across the business. So real challenge in terms of bringing that through.
Excellent. Right, now it's probably a sensible time to stop and have a look at some of the questions that are coming through. So there's a really good one that came through in testing, but I'll park that and we'll come back to it when we cover off on the testing. But there's two here. One is, what do we see as the challenges with third and fourth parties when mapping out business services?
I'll put that one in, sure.
Yeah.
So we've had a lively debate this morning on operational resilience with a number of our clients, and no surprise that third parties came up, as it seems to. It's a real challenge that everyone's feeling. The main challenge that our clients are raising to us are the expectations are going up. You need to get more information, more assurances through from your third party. But that's not written into contracts just now. So you can ask for more, but third parties, understandably, until that's written into contract, they're a bit reluctant to provide you with more, and they're pushing back quite heavily on that.
Yeah, and I think if I jump in with my perspective as well, I think those that do find themselves as third parties, so providing services into financial services clients, especially those that are non-regulated, the ones that are at the forefront of this are starting to see it as a competitive advantage, and therefore getting in the front foot with this and being able to demonstrate is, in the weeks and months to come, will bring competitive advantage, because when firms are mapping out their processes, they are going to have to understand resilience within third parties and are going to have to get those questions answered. And those third parties that are dealing with that now are those that will ultimately see themselves getting a competitive advantage.
And we've seen from some of these case studies, a number of these issues do relate to third parties where something's gone wrong that you're not aware of, so that end-to-end view absolutely helps do that.
Another question that's came through related to business services, and this might be one for you, Lewis, is what are the challenges we see when mapping out end-to-end business services? What should organisations be doing to make it work well?
I think where this works really well is when you have the ability to kind of pull together the data you've already got on the service, whether it's the BIAs or any other documentation, to allow you to stitch the process together at its highest level before you then start to engage with the business. Otherwise, you can then have some very stale and static meetings where you're trying to explain what's going on. You don't really have a full view of where you think the process is going to go. But the key to getting it right, and getting it right first time with maybe a second pass to check accuracy, is to get all the key stakeholders in the one room at one time and really kind of talk through that process. And that's appropriate people from the business teams that are operating. Say if it's customer credit card, it's kind of the teams that are managing giving the card out, to those that are kind of managing the call centres to speak to customers when they're calling in, the people that drive the technology, the third party supplier owners. If they're all together and you can really interrogate those hand-ins and hand-offs between different teams and different technologies, you get to understand the process, the critical steps, those areas within the map that absolutely must happen, because if they don't, the process will fail, and there's no, whether you can substitute or have a workaround in place. You drive that out in a workshop in its first go. So that's definitely the way to go. I've seen some people try and stitch it together with individual conversations back and forward. You just don't get that cohesive and full picture of the end-to-end.
Fantastic. Well, listen, please keep these questions coming in. As I say, I'm holding this one and testing till we get to that section. But if there's any other questions, then please send them in, and we will do our best to answer them. So, moving on, impact tolerances. Lewis.
After the management of third parties, the impact tolerance is probably the second area that's causing some headaches on the back of the discussion paper. Mostly because people think, well, what are impact tolerance? Why is it different? Why is it not just our risk appetite? Now, we did a bit of work with the PRA almost 2 years ago now, where they felt that risk appetite was the wrong language for them to be using as the regulators, and they wanted to talk about impact tolerance. Little did we know that it was going to morph into this new requirement in the discussion paper, and it's really based around can and could tolerate, or will and won't tolerate. So you can tolerate your risk appetite, you cannot tolerate your impact tolerance, because that is the point you're about to become a firm within resolution, and it's the plug has been pulled, and you need to be able to articulate that point in the sand that you're fundamentally broken and you will never return from. So, what are the regulators looking for? Fairly text-heavy slide, but they're kind of looking for an articulation of the tolerance statement across those impact categories, which should be common to almost all of you on the phone from your kind of op-risk impact matrices, and for you to kind of define both qualitative and quantitative parameters for those impact types. At the moment, it's kind of accepted that the majority of the impact statements, you're going to struggle to have the metrics or to really understand what's kind of the measures that are there, because it's going to be a work in progress and a moving area as it kind of this matures and beds in across the organisation. You need to consider the impact across multiple factors. So it's the kind of the speed of the service, the quality of customer service, the kind of putting that lens of what's important to the customer over what you're doing and making sure you're not impacting them, and you're able to provide them the service that you define to them when they start a contract with you. Typically, we're seeing people define an impact tolerance statement for each of the critical business services because they can be different. You're going to tolerate more of a loss within different services, so you kind of to define those different levels. It is kind of where we're seeing it work, and kind of once you've been through the mapping and you understand who the business service owner is, it's typically someone from the frontline business. They then own that tolerance statement and make sure the kind of metrics and the MI and the appetite is supportive of that. Sorry, and then kind of the next bit, I think it's the right-hand side of this slide really is the key takeaway, that you've got all those impact categories and the subcategories and metrics, and it's going to be a sliding scale of impact across those categories that you're looking to work to and to manage to. So you know that you are going to breach your maximum impact for your customer loss or transaction values well before you're going to hit your conduct or your regulatory breach, and there are different points that are going to happen over time. But you need to be able to understand the flow of tolerance up until that point. So it's no longer, I think the bit that doesn't work is the old RTO, recovery time objective, recovery time capability. It's a language that PRA in particular would like you to move away from, because everybody knows you miss your RTO, and no one really cares about what does or doesn't happen when the RTO is missed. You can set an RTO of 4 hours and you're back within 8 hours. Okay, what happened? What happened in those extra 4 hours? Did you break? No. So therefore, you're kind of tolerating that impact. So you should be able to kind of look and say, okay, day-to-day on payments, you maybe have a number of batches that get sent back to you because something's been coded wrong, and you're tolerating that because that's part of your day-to-day BAU, and that's your lower level of impact. You need to be able to articulate if all of the batches are being sent back and all of the payments are failing, what's the stress you get to, and how long will it take you to recover back to that point of normal from there? And you've been able to monitor it through kind of some leading indicators through your tolerance, the bandwidth of tolerances.
There's a couple of questions coming in here, Lewis, that you've touched on, but let's ask them so that you can fully explain. One was what you were just literally talking about, the difference between impact tolerances and the traditional business continuity language of RTOs, so recovery time objectives or maximum acceptable outage. What's the sort of key differences between them?
I think on the impact tolerance, the idea is to be slightly more scientific with the loss or the impact or detriment to the customer or to you as the business. And you kind of, it's no longer just that. So RTO is very black and white. It's a point of time, and it doesn't really define what's happened or what you've lost up to that point of time or why you've set it. I think the kind of the tolerance metrics will allow you to understand that from a minor event, you may have lost £100,000 worth of revenue, and you're happy with that. That's fine, because your normal daily operating's up in the millions. It's to kind of translate that back to what the cost is to you, the cost of remediation, the cost of impact, and the cost to the customer.
Yeah. Okay, and then the other one is, and this kind of lets a little bit to stress testing, which Pete will touch on in a second. Who defines impact tolerances? Is it the firm themselves or the regulator?
As I kind of mentioned, this is a good question. As I mentioned at the start, we've done this work with the PRA to kind of help them define their tolerance statements and their kind of tolerance for the wider financial services sector should there be a large-scale incident or an outage that's affecting multiple firms. They've done that work and they have the tolerances. They chose not to share those with the firms and have asked that firms define their own tolerances, and these are then to be able to report back to the PRA and the FCA, we believe will then kind of start clubbing together similar organisations using similar products and making sure that kind of tolerances are aligned and that kind of there is parity across the sector that they are comfortable with. So it is down to the firms. It needs to be signed off, approved, all the way through kind of the board governance. They need to understand this, and this will be one of the questions should the supervisors come in and you've had an incident to 166. It's your board that are asked these questions and asked how they came up with them and how they support them.
Fantastic. And the final issue that we're going to touch on is stress testing.
I'll pick up on that then, Stuart. The last of the big four issues as we've kind of outlined it. So in terms of stress testing, it's nothing that's new from a financial services perspective. So we've had financial stress testing for a number of years, but it's something that's new in the sphere of operational resilience. And really what the regulator is trying to achieve here and what it's designed to do is to help you understand and challenge both what you've defined in terms of the critical business services that you've identified, but also to challenge on what Lewis has just been talking about there, which is about your impact tolerances. Have you got those right? Do they need to go up or down? Do you need to take action as a result? And when I kind of first heard the term stress testing, I thought, so what does that mean? How do you do that? What does that mean in practice? So what we expect the regulator is really looking for in terms of a stress test is really that kind of desktop walkthrough of a scenario. So if this happened, what would be the impact? What would be impacted from a service perspective, and what would be the impact on customers or outcomes as a result of that? So really it's kind of getting the right people together in a room to walk through, to challenge, to understand and to stress different scenarios, situations through critical business services and to work out what that means. I'll maybe just now touch on a few areas of the slides because it helps bring it to life a bit more. And what we've kind of got on the left-hand side is a number of potential scenarios on which you might apply a stress test. So we've got cyber-driven access issue, data integrity, counterparty not being available. And the idea behind these scenarios is that they're all severe but plausible. So the impact's pretty severe, but they could absolutely happen. And I think each one of these, we've seen real life events over the last 12 months which fall into that category. Once you've got your scenario, you're doing your desktop walkthrough, you'll think about, well, what would be the impact on the service that we're talking about here? So if this component went out or that component out, I'm very much walking that through into the impact, both from a qualitative perspective, but also quantitative as well. And we've kind of captured 4 areas which you might want to use to, provide context to the output. So operational, be it financial, reputational being a key one, and compliance as well. So as I say, trying to take the theory and challenge it to make sure that you're focused on the right areas.
And I might just pick up on something Lewis referred to right back at the outset about the minutes from the FPC meeting that were issued in the last couple of days around about stress testing. So for those of you that missed it, what that has announced is that there will be a pilot in terms of stress testing. 10 firms will be selected. It will be a cyber-related incident that makes payment systems unavailable, but data is not corrupted. And what firms will be looking to do is confirm that they can make payments within 24 hours. And if they can't do that, what is preventing them from doing that? So that is coming later in the year and has been announced. So it means that this stress testing piece has been taken seriously again, and it is actually going to happen. That brings us to the end, I guess, of the slides that we have to talk through. So please send through any questions that you have that you would like us to answer. I've got 3 here that we will cover off, and we'll start with the one that I parked from earlier. And that, in essence, is saying that it's appreciated that individual firms have a requirement to do operational resilience related testing, be that business continuity or disaster recovery in old language? But do we foresee requirements from regulators for suppliers that provide services to multiple financial services organisations having to do testing? So this is, I guess, is whether we see this is your third parties that are providing services across the industry, be they regulated or non-regulated. I guess the question moving away from testing may well be, do we foresee them becoming part of a regulated regime, or how do we see them dealt with?
Pushing back the perimeter as well.
Yeah.
I think there is one of the largest bits of feedback on the discussion paper, and it's one that the kind of regulators have taken into consideration, is that management of third parties and kind of the oversight you can have of them, and joining them into testing in this example, and really kind of being comfortable with the service they're providing, and then proving their ability to recover and respond in line with your criticality. It's a big ask. It's difficult, and kind of the contracts are in the right place, and the relationships with third parties are not really allowing this to happen. I think there are a number of firms now who are feeling a degree of pain from the FCA in particular around one well-known supplier who's providing the same service to a number of retail banks, and the inability to understand their resilience requirements and what they're doing for them. And it's the banks that are feeling the pain, and the suppliers still not giving the answers because they're not regulated. They're the perfect point in case of a firm that will become within the boundaries of the regulatory perimeter. There is a mechanism in place. The Vocalink is now within the perimeter, so it's happened, and I think they will look to bring some of those key suppliers into the perimeter.
What I would say is that so it's recognised by everyone as a key challenge. No one's debating that. I think the solution is less clear, and I think that the regulator really has taken that feedback on board. So it'll be interesting to see where they land in terms of that third party piece, because they may have changed their position somewhat in terms of the initial views from the discussion paper. What I would say as well here, and what we often see where there's kind of new regulation coming out and it's expecting more third parties, is that there tends to be a bit of a journey from where you are now and where we may end up. And I don't think that things are going to change in the immediate term, but maybe in 2 or 3 years, that's a more likely timetable over which expectations around third parties will increase. More people will be asking the same questions, and there'll need to be some kind of collated and consistent response.
So I guess in answer to the question, what we're saying is that there is nothing that's been published in terms of direct regulation at the moment, but 2 things. One is the mechanism is there to bring people into the perimeter and being regulated. And then secondly, the piece that I referred to earlier, I think market forces will dictate some of this as well, and that if firms are having to map out their end-to-end processes, are having to go to third parties to understand the operational resilience, those that have done it and can demonstrate it will get a competitive advantage from that, and firms will those that are non-regulated will have to do that. There's a question come in on impact tolerances, which Lewis is just reading, but let me pick up another one and I will answer that. It's about this terminology that's used, severe but plausible, and what does that mean in terms of actually testing? It's a really good question. So what we're saying in one hand of the spectrum, we're not talking about desktop exercises that are so rehearsed in advance that you come out with the right outcome. But certainly on the other side of the spectrum, nobody's suggesting that you go and pull the plug on a server hosting a critical application. It's somewhere in the middle. It's making sure that organisations have really thought through what the potential events are that could impact them, and they're doing a a test that really tests that using, historical and live data as much as they possibly can.
What I would say is there's been a bit of a move on this as well, so it's kind of gone from these extreme, never going to happen, cataclysmic type events, so your proper disasters. That's softened a bit, and I think that what people and the regulator and firms now understand is there are events that are very plausible, and we've seen them time and time again. They can happen that have a severe effect, so it's softening the likelihood of it, but not the impact. So that would be my take on it.
Yeah, and I think that to kind of help support that, there is plenty out there that you can look and kind of help build a scenario and kind of pick up the data. If you look at the PRA and the FCA's website, all the notices, the final notices, they're all on there, and you can get a lot of detail of what actually happened to kind of help build your scenarios out. And as you said, there's things that we thought would never happen have started to happen fairly frequently. Question in there, kind of asking, with respect to impact tolerances, do you see the regulators providing guidance or a range of bandwidths for similar firms to sit within? Yes, I think they're going to have to. They are going to sit and let everybody respond with their impact tolerances, but they will look to kind of to baseline and benchmark those against similar firms. And whilst they would never tell you that you are wrong, because they will assume and they will test and check that you've gone through your due diligence to come up with those tolerances and you've set them in a way that is appropriate to you. I think they will start to benchmark the outliers, kind of those that are happy to tolerate too much risk or too much loss. They may question those firms and start to bring them into line with the rest of the sector and in line with their understanding of their impact tolerance for the wider financial services.
So this question is a very broad one, and it's, what would you say are your top tips to ensure operational resilience is a success? I guess let me answer that first, and then I'll put the guys in the spot to get their views.
Well, you're getting in there first, so plenty to go for.
I'll take the easy ones in terms of getting this. I guess I would answer that from two angles. One is making sure your program is a success, and then if God forbid you do happen to have an incident, what gives you the best chance of actually recovering successfully with minimal impact. So if I take the program first, again, there's going to be no surprises in here. I think this is around about having senior sponsorship and oversight. The reason I say that is, when you start doing the likes of mapping out end-to-end services, if you've got somebody that's senior and accountable and can actually make sure this is prioritised, and then when you do inevitably have functions that are working in silos but need to come together, they can support you in making that happen. That makes life a lot easier so that everything's prioritised accordingly. In terms of, the best success, if God forbid you do have an incident, over the years I've been involved in a number of these, and those that do well are those that have prepared well. And therefore, what I would say is test. So all this preparation work's really important, mapping out end-to-end services, understanding people, process, technology, third parties, etc. that support that, making sure you understand the risks, mitigate the risks, and then you test with, using that language again, but severe but plausible scenarios.
I think, Stuart, you started off by saying you were going to do one and probably covered off on about three there, so you've left it a little bit challenging, but I'm not going to try and say anything different. I think the key point for me comes down to accountability, roles and responsibilities, and getting the right people involved at a very senior level, because some of the key challenges which we hear from our clients again and again are not being able to break down those silos, not being able to get the right engagement from the right people, because it's happening at a more junior level than it needs to. So I'd probably echo your point around who's owning and driving and accountable for your resilience program, who's asking the questions, and who's really keeping it on the agenda.
Yeah, I think the tie in that where I have seen this worked really well when all three lines of defence are fully integrated into it. They all understand what they should be looking for, the challenges they should be having, and the gaps they should be helping to plug within the programme, and really kind of working together to make the banks, insurers more resilient and challenging across lines of defence. But it's when it just sits in the first line with no real oversight and no challenge, then it can start to fall flat.
And I think that joint voice can also be quite powerful in terms of raising the issue up the agenda as well.
Excellent. Well, listen, thank you very much for everyone for joining us today and for sending your questions in. It has made it a lot more interactive and hopefully has made it more relevant for yourself. As I say, thank you once again, and we will end it there.